session this afternoon is David Harvey commenting on the falling rate of profit in Marx's crisis theory, and David will have up to 45 minutes. But the less, of course, then the more time for discussion.
Yeah, I want to leave as much time for discussion as possible. And, sorry if visitors think I'm going to give a coherent talk for all of you, but we're talking about some issues here and have been for some days, and it's in that spirit that I'll venture a few comments. And I want to thank you for inviting me to this meeting. It's actually not very often I get the opportunity to sit down with economists. I'm fearful of them usually, but they seem to be not bad guys. Actually, so it's. But I thought that something that's come up during the conference that I thought that I would raise and start with, which is not in the written paper, and it's. I'm a bit leery of causal language, and when you postulate the question, what's the cause of the crisis, it seems to me sometimes that leads into somewhat wrong answers. And I'm leery of causal language because my conception of capital is that it is both a process and a thing. It's rather like the famous controversy over what is light. Is it a particle or a wave? And the answer quantum physics gives eventually is that it's both. And there's this question, is capital a process or is it a thing? And my answer is it's both. But it's a process that appears as a certain thing. It appears as money at one point, as productive activity at another, commodity at another. I think it's important to look at those metamorphoses of form that capital takes. And also to ask questions about what are the capacities that capital has in those different forms. For instance, the money form, as I mentioned earlier, is the butterfly form. It can flit around all over the place. The commodity form can sort of move around. Production is harder to move, not impossible, but so there are many differences. And there is something very important which relates to the paper we've just had, which is the money form is the only form of capital that can be accumulated without limit, without any limit whatsoever. And I think this is important because there's a tension, it seems to me, between how to keep a compound rate of growth going in a situation where there seem to be some limiting factors around on both commodity production, inputs, and all the rest of it. And some limitations on productive, the organisation of productive capacity. And the tendency to move to the money form has a lot to do, I think, with its limitless capacity. And so we might want to throw that into the hopper. Now the process for me is, of course, paramount. And people have used analogies about sick bodies and medical and so on. My analogy is essentially with fluid dynamics. Capital began as a trickle, it turned into a stream, it turned into a river, it turned into a mass. And now we've got capital sloshing all over the world. And within that stream, which is constantly increasing, which is of course one of the features which is central to capital's nature. There are eddies here and collapses there and barriers somewhere else. So if we were sitting and having this meeting in Detroit, we would be very aware of a place that's in terrible crisis. I look at the window out here and it doesn't seem to me that Izmir is in a terrible crisis. There are of course always problems around, but that's not the issue. The question is, how is capital accumulation doing? In my visits to this region, I've often had the interesting experience of shuttling forth between Istanbul and Athens. And of course, the contrast is dramatic in terms of what you see. So capital is like that. So there are crises in particular places at particular times, and they're fierce crises for the people who live through them. Earlier we were talking about the crisis of deindustrialization, that cities like Baltimore and Pittsburgh and so on, and Sheffield and Mumbai went through. But then the question is, when do we start to actually take when do all those mini crises, as it were, come together to create some mass kind of global crisis where everybody feels some sort of stress at the same time, although with different intensities in different places. And how does it then, that crisis, move geographically? A crisis that began in Southern California and American South in general, then switched into the financial system, and anybody who had been stupid enough to buy any of those collateralized debt obligations suddenly found themselves in crisis, be it a German bank or a French bank or a Norwegian municipality. But if you didn't buy those things, you didn't feel it. What you did feel is when the US consumer started to deleverage from housing markets. A, they couldn't remortgage their finance and use that to go buy things, and B, they couldn't spend their money on other things. So suddenly the collapse of the American consumer market had tremendous impact on those countries that exported to the United States. China lost about 30 million jobs by the beginning of 2009. But the interesting thing about China was, by the end of that year, they'd only had a net job loss of around 3 million, which means that somehow or other they created 27 million jobs in about 9 months, which was, of course, this vast program of infrastructural investment and the like. So the crisis moves around, and you never know where it's going to be. There's a sovereign debt crisis in Greece. Suddenly Dubai World goes belly up, and it's in the Middle East, and you don't know where it's going to occur next. The BRICS were doing very well, but Brazil's in a lot of difficulty right now. I mean, things move around, and so they move around sectorally from one sector to another, as well as moving around geographically. And so I would want to talk about that flow across space and time. And the causality in that is kind of a little hard to establish, because actually the situation today is very much is by definition defined by what it was yesterday. And actually this is a good principle of forecasting the weather in many parts of the world. If you say the weather tomorrow is going to be exactly the same as it is today, plus or minus of 1 degree or something like that, you're going to be right something like 65 or 70% of the time. And if you're in the tropics, you'd be right 100% of the time. So this is a kind of a flow version. Now, what I did in the paper, of course, was to kind of get a little annoyed at those people who kind of say the crisis of 2007, 2008 was a result of the falling rate of profit, and it's just, it doesn't seem to be, it was terribly helpful. It doesn't seem to me it's particularly true, so I decided to go back and do a little number on what I thought about the falling rate of profit theoretically, and what I think about some of the proofs that supposedly exist of its existence. Theoretically, I'm not going to go through how it's defined. Everybody here knows it. It has countervailing influences, and it also, there's a third chapter in Volume 3 where he talks about, the heading of which is internal contradictions of the general law. It turns out, since I've been exposed last week to finding out what Marx's notebooks look like, from which Engels prepared this material. And the original notebook, which is one manuscript, it's not 3 chapters. Engels supplied the chapter headings and quote, clarified, in some cases exaggerated, certain aspects of the argument. Most spectacularly in the point where Marx talks about factors that could make the interest rate, could make the profit rate rise. Engels ended it by adding his own sentence, which said, but in the end we know that it falls as we've already shown. So that Engels was a bit more, kind of excited about the falling rate of profit than Marx was. What came down to us is the third chapter. When I was writing stuff about this in Limits to Capital back in the 1970s, I kind of found that the law, which then became a law of a tendency and then became a tendency, I found by the time you went through all the countervailing influences, which were 6 listed in Capital, but if you go to the Grundrisse, there's 4 or 5 more, most important of which is the opening up of new sectors which are labour intensive. You know, it seemed to me it was a kind of pretty much of a wash. You didn't know whether the profit rate was going to go up or whether it was going to go down. It didn't seem to me that there was any kind of firm thing, you know. But most of the language, it turns out, suggests it was a firm thing in spite of all the countervailing influences. Most of that language turns out to have been inserted by Engels. It wasn't there in Marx's original thing. The other thing is that Marx himself didn't seem to use it very much. You can't find it in his political writings almost anywhere. The 2 crises he looked at in Volume 3 of Capital, 1847 and 1857, were analysed as financial and commercial crises, and there was only one passing reference to the falling rate of profit. And it also turns out, and I learned this from Fred Mosley last week, is that Marx never came back to the question of the falling rate of profit after 1868. So he had at least a dozen years in which he was actively working on the manuscript where he never touched the whole thing. And he just left it as it is, even though it was obvious that it needed a good deal more work to really substantiate what he was talking about. So there's a sort of growing consensus among most people, not Fred Mosley, but many people, that actually the emphasis upon the falling rate of profit doesn't really concur very well with what Marx himself held. And I felt that when writing Limits to Capital way back, but I found the most interesting part was what we now call chapter 15 of volume 3, which Engels calls the contradictions of the law. Now, actually this is a wrong title. To say it's contradictions means the law exists but it's contradictory. What it should be titled is something like what happens when you abandon the assumptions under which the law was derived. Because it turns out that the law of falling rate of profit was actually derived under exactly the same assumptions as defined the general law of capital accumulation in volume 1, and Marx is very explicit in volume 1 as to what those assumptions are. First, there is no realization problem. All commodities sell at their value, which means there's no problem in effective demand in the market. Secondly, the way in which the surplus value is divided up between rent and interest and profit of enterprise and all the rest of it doesn't matter at all. And thirdly, you're dealing with a closed system. That is, capital is everywhere established, and that therefore there's no trade with non-capitalist organisations and the like. And those assumptions are very clearly written out in volume 1, but they turn out to be exactly the same assumptions under which the law of falling rate of profit is derived. And then the question arises, well, you build a model like you did in volume 1 of Capital of the production of the industrial reserve army, and it's very useful and helpful to understand certain aspects of the dynamics, but you can't take it too far. In fact, if you don't start to put in the fact that actually working class demand has a very important role to play in all of this, then you come to a very wrong conclusion as to what the dynamics of capitalism might look like in general, as opposed to what they look like under the assumptions that Marx used in volume 1. And I take the same argument about the volume 3 falling rate of profit argument, that the whole kind of question of the rate of interest and all those sorts of things is excluded from Marx's analysis. Though in Anwar's description of profit rate, I notice the interest rate gets deducted, which it seems to me is going beyond Marx's assumptions in interesting ways. So, but in volume 3, in chapter 15, Marx does all kinds of other things and starts to say, you know, look, one of the first things that happens when the profit rate falls is you go in for a bout of another bout of what he calls primitive accumulation, or I like to call I like to call the accumulation by dispossession. And in fact, he raises the question of the aspect of accumulation by dispossession, what he calls decapitalization that occurs through the centralization of capital and the eradication and elimination of many small capitals. That this decapitalization plays a very important role in restoring the conditions of profitability, so that Then this arises in the final part of the paper by me talking about accumulation by dispossession in housing markets, how much assets were actually stolen by thievery and robbery and all the rest of it. So I want to reintroduce that into what capital is about, and because if you don't reintroduce that, I think you miss out on some of the important things that have been happening through what the financial system is about. And I would remind you in Marx's chapters on primitive accumulation, one of the primary means by which accumulation by dispossession occurs, and primitive accumulation occurs, is by the credit system. So if you look at the role of the credit system in the transfer of property rights in the 1930s in the American agrarian sector, and you then look at the transfer of property rights in the housing market very recently, you see a massive transformation of asset values going on through this process. And this is kind of clearly articulated, and of course, as one of the ways in which the profit rate can be restored, which is going back to, I think, what Anwar mentioned the other day, sort of a version of profit on alienation, but I prefer to use accumulation for dispossession, because we're not talking about alienation here, you're also talking about robbery, thievery, thuggery that was going on in the housing markets of the United States, in which some 7 million households lost their, which is about 30 million people, lost their homes to a predatory system, and a lot of it was illegal, and it turns out to have been illegal. So that enters into chapter 15. The other thing that enters in is, well, what happens when we actually drop the idea that we have a closed economy? So he starts talking about, well, what happens when capital starts to flow abroad? What happens when it finds other places to do things and engages in what else we call a spatial fix? What does it do? So that then gets introduced, and then of course aspects of the credit system, but perhaps most important of all is the way in which Marx actually treats the question of working class consumption and restriction on effective demand by the fact that you've got a class divided society in which money is circulating to the upper classes in ways which are unlikely to actually circulate back into consumption in any kind of real way, back into the real economy. And the largest segment of the society is suffering from wage repression, and the greater the wage repression, Marx argues in both Volume 2 and Volume 3 of Capital, can be a major cause of crisis. And of course in Volume 1 of Capital, it was the other way around, that actually advantageous conditions for labour to actually press its demands can actually lead to a fall in the profit rate simply by, so either way you get a fall in the rate of profit, either by wages diminishing or by wages rising. You're likely to get some impacts on the profit rate that can go one way or the other. So this was, if you like, some of the theoretical reasons why it seemed to me that, again, the whole kind of question of falling rate of profit becomes a sort of wash. It could go one way, it could go up, it could go down, go this way. And there are several people now working from the mega manuscripts, most of all Michael Heinrich, though he takes it a little too far, I think, who starts to say that the falling rate of profit is no basis for understanding crisis theory in Marx, and I think that actually I drew a lot of my ideas about how to understand crisis theory from the chapter 15, which changes the language from falling rate of profit to overaccumulation and a plethora of capital, and surpluses of capital and labour side by side as being the defining moment in the way in which crisis tendencies of capitalism, which are omnipresent, come together. Now I then went into sort of, okay, but everybody who talks about falling rate of profit usually has a graph, and I'd be very interested when the book comes out, John, to see how many different graphs there are of what's happening to the profit rate in the different chapters, and see how they all actually relate to each other and what they look like. Because they
we could have an overlay.
Yeah, no, you could actually, or a diskette at the end where you could go play with all of the data. There are two major issues I have with that, and a lot of minor details which I won't go into, including how profits get declared, what do we do about transfer cost pricing within corporations, where's the profit made, where is it realised, all those kinds of questions. But the two major issues are, first of all, just because you've got a graph of the falling rate of profit doesn't in any way prove that the mechanism that Marx was appealing to is in existence. In fact, the profit rate can fall for all sorts of reasons, and so to talk a lot about the falling rate of profit in the sense Marx talked about it, and then give me a graph of what happened to the profit rate doesn't do anything. And then the graph that Al had on what happened to the profit rate in a time of falling productivity from the 1960s onwards was, I think, a very good example of well, it looks like there must have been Marxist mechanism, but clearly it wasn't Marxist mechanism that was behind that fall, it was something else. We can discuss what it was, but it really was something else. And so that's the first kind of point I would want to make. And if you want to show what the mechanism is, you have to show something about productivity. And of course the thing that everybody appeals to, but is less anxious to measure, is the value composition or organic composition of capital. And frankly, I have real problems with that as a concept. I think it's a pretty incoherent concept. And I think in aggregate it doesn't mean anything at all. So I have real problems with that. The second thing is that everybody, of course, uses the monetary form of profit. And there's a real question as to what's the relationship between money and value. And there's a real contradiction between money and value. Money is an indispensable representation of value, but like any representation, there's a big gap between what it itself is and what it's supposed to represent. It's like maps, being a geographer, I know that you can lie through your teeth with maps. In fact, it's one of those, it's a very sophisticated way, it doesn't show everything. And so money, and Marx talks about this in Volume 1 of Capital, is contradictory because it's a privatized version and a material privatized version of what is a social concept. So social labor is represented by a material thing, and the material thing has certain qualities. But that material thing actually turns out not to be very good in terms of the money commodities for circulation. So you get fiat monies and you get all those sorts of things coming in. And so you get a peculiar thing, we get a material representation of a social process, and the material representation is the money commodity, which is inadequate. And you then get a representation of the material thing in terms of the fiat monies. Now this is a big gap between what these fiat monies are about and what they're measuring and what the value theory is talking about. And money escapes, as it were, any kind of foundation in value itself. And so when money escapes in this way, and I mentioned earlier that it's therefore can become infinite. It's possible to create money infinitely, just add a few zeros to the money supply, and you can carry on adding zeros. You can't do that with commodities. Imelda Marcos had, 6,000 pairs of shoes, but she couldn't have millions and millions and trillions of shoes. But you can have millions and millions and trillions of dollars if you want. So the capacities of what happens with the monetary side of things become somewhat different. And as Marx also points out in Volume 1 of Capital, there's not only a quantitative deviation between what money does and what value is about, there's also a qualitative deviation. That money can be applied, and so you can start talking about conscience and honour, which are worth a certain amount of money. Now, what money is and how it gets in terms of valuing things, that becomes very, very significant. The relationship between, say, the value of a Nike shoe in the sense of Marx talking about social labour, and its monetary value, which has a lot to do with reputation and all kinds of weird things like that. And this is true of stocks and shares, and it's true of housing, and it's true of all of these things that have no clear value apart from that which you get when you take it into the market and start to say, I want X amount of money for this. So the qualitative shift to all these non-commodity forms that can then become commodities, like carbon futures, like You can create all these crazy markets of fictitious capital which then circulate around, and people can draw money to wealth out of that and become monetarily very rich without actually engaging in any production whatsoever. So this relationship between, this contradictory relation between money and what it's supposed to represent is left aside entirely in all of these accounts, and everybody assumes it's okay, you know, you've got this monetary measure of value, and we just go in and draw the graph in monetary terms, and that's actually representing what's going on in the value sphere. Well, it's not. It may be representing something that's purely going on in the monetary sphere and is subject to something else. So without finding some way to make sure how capital, as measured in money terms, relates to the value form, and I think there are ways in which this can be established and thought about. And, Marx had, I think, some interesting kind of concepts of that. That relation seems to me to be something which we really need to look at. And I've raised this before, but we haven't got back into it. I think the abandonment of any mention of gold and silver after the early 1970s as having anything to do with the global monetary system has had very, very significant impacts on why financialization has occurred in the particular way it's occurred. I mean, I'll give you my story about it. I mean, okay, any connection with the money commodities was severed. By the end of the 1970s, you have incredible inflation. Well, what happens? They suddenly realize that the people who have to control the inflation, given that the material base has been swept away, are the central banks. And what do the central banks then become? They become sort of anti-inflation. And so we get, you know, what Krugman and everybody else complains about is this kind of incredible kind of fear of inflation. And it's very interesting reading the Federal Reserve minutes of the summer of 2008, just before Lehman Brothers was about to go crash. And Krugman gave an account of this. And there's something like, in the conversation, there were 250 mentions of inflation and 3 of a crisis. And there you are, headed towards a crisis, and all they want to talk about is inflation. I mean, this is kind of, but this is central bank dogma, but it has to be there because you'd abandoned the connectivity to the value form. And the only way you can keep that connectivity is, in fact, by central banks somehow or other, trying to keep things in some sort of relation. So anyway, the data seem to me to be really all over the place in terms of what they can help us understand. And I'm not saying they're irrelevant. In fact, they're very relevant because they provide the basis upon which public policies are often determined. No public policies are actually determined on the value theory, and no corporation decides on the value theory. They decide on monetary signals. So the monetary system becomes absolutely crucial. So I have all of these kinds of reservations about it. My own view is that 2008, I start to build a little bit an alternative way to think about crises in the midst of this critique. My own view is that actually there was an excess of capital after 2000 and low interest rates and all the rest of it, and it hadn't got anywhere to go, so it went into the housing market. And of course you got the bubble, and then of course you got the crash, and then the way in which that market is a huge market, $14 trillion in the American mortgage market, and an economy of 15 trillion. This is a very significant whack. But this explains why it became so big, because that's a very big market into which, you know, my flow of capital was flying in there and sloshing around and raising prices and doing all these things, and it's getting collateralized debt obligations, and the debts are offloaded here and there and everywhere. And so it had a way of going global, which other crises have not done, but it didn't go totally global. And there were certain parts of the world that could really come out of it very fast, like China and Latin America to some degree, and raw material producers. So there are many things here which are involved. The other one, which I just vaguely will point to, is that Marx at some point says, well, you know, the fall in the profit rate can be actually compensated for by decreases in rents and taxes. Now, that also, what follows from that, the decreases in the profit rate can actually occur by increases in rents and taxes. And there's an interesting kind of question right now, and I'd be very interested to put this one on the table. I think capital is moving into much more of a rentier economy. Rentier in the very, very general sense, in which the aspects of distribution in both rent and interest are dominating everything else, and that therefore money is being extracted from those spheres in very particular kinds of ways. And what this would suggest is that Keynes' euthanasia, the rentier, has not taken place at all. In fact, it's the other way around. There's actually a possibility of a reversion to a Ricardian type falling rate of profit crisis, which is based on rising rents, but for completely different reasons. Ricardo put his bet on Malthus and scarcity and diminishing returns in agriculture. But what we're now into is actually monopoly control of many assets. And we're seeing a land grab going on in Africa. We're seeing all kinds of signs of capital moving to preserve its positionality by investing in assets rather than actually investing in production. So we're getting these asset bubbles all over again, most seriously, of course, right now in China. So let me leave it there and let other people sort of shoot away about their views on what way to profit.
Okay. So let's have a preliminary indication of who's got a question. So we've got 1, Sadat, 2, Johnny, 3, Stavros, 4, Anwar.
Thank you very much for this presentation, David. I'm particularly happy that you have mentioned money in its commodity form and the way in which it plays a role in circulatory capital and how this turns into fiat money and so on and so forth. I listened to your analysis very, very carefully, and I sympathize a lot with that. During your talk, starting with money in a commodity form, turns finance is something into an endogenous variable of the capitalist economy in which it functions, and that also relates to the creation of money, which is coming from the indigeneity nature of that creation, which puts, as opposed to what financialization literature tells us, that finance is in a set of architectural assets which can exist exogenously out there, which will have an impact upon the real economy and so on and so forth. Now, I listened to you carefully, and in your talk, you only mentioned financialization once. But when you are describing capitalism, you talk about excess capital turning into, going into the property market and creating bubble as such. And also capitalism is a rentier economy and so on. Do you have a problem with financialization, the concept of financialization? That doesn't explain itself.
It's so broad it doesn't mean anything to me. So I want to look specifically at the flows, and it's like talking about speculation. Actually, every capitalist is a speculator. They have to be, but our general sense is that speculators are bad capitalists. So I actually, and then I can use the term financialization, but I don't use it very much because it just means too many things.
Yes, thank you. That was quite interesting, David. But you were a little bit naughty because you did sweeping criticism of just about everybody that used the term falling rate of profit or even measurement of profit without being very specific. So I think it's going to be a bit difficult for those people to defend themselves because they don't know exactly whether how much if you tossed out the whole bathtub or just a rubber duck out of it or what. So I'm going to try to get down to a few specifics. And the first step, I would say, do that, is I think that Marx wrote many things. Different people have different interpretation. So it's not, well, I give you a copy of my book, I have many quotations from Marx. It probably isn't very productive in this context to refer to what Marx meant, because just about your opponents could do it also, and then it would come down to which quote you want, how you interpret it, and so on. So let's get specific. I would say on the question of profit and its measurement and so on, it seems to me the first step is to clarify the production of absolute surplus value and relative surplus value, and that do these measures capture what arises from those concepts. So for example, when you talk about profit, do you see it as in this epoch as something that is being generated by raising of surplus value absolutely, linking working days, suppression of wages, so on, or through raising surplus value relatively, reducing the value of labor power in effect, or a combination of the two?
Oh, I see it as a combination of the two. I mean, there's no relative surplus value without absolute surplus value, and absolute surplus value always has a basis in a certain technological configuration.
Okay, we next have Anu, I think.
Stavros, I think.
I'm sorry, Stavros, I beg your pardon.
Anu, do you want to?
No, please.
Well, first of all, I'll put forward a carry, but before that, on the point that John made, you mentioned very much that capitalism is becoming nowadays a rentier economy, and another form of exploitation, that is exploitation by appropriation, becomes important, and even more important than traditional mechanisms. So how this affects your answer to John's query, that is how relative and absolute value, surplus value are related. It is obviously accumulation by expropriation is obviously a different exploitation mechanism than the extraction of surplus value. Do they relate in any sense, or no? They are totally independent. First point this. The second, okay, let's drop the tendency of the rate of profit to follow under consumptionism or whatever. As a monistic theory of crisis, I want to carry a bit your explanation of the current crisis. I'll try to reconstruct your argument and tell me if I'm correct from what I've written in your paper given before and what you said here. You are saying in your paper that the 2008 crisis was the culmination of a series of crises in which accumulation by dispossession orchestrated through the credit system became a significant lever of crisis formation. Series of crises, I presume you refer to the 1990s crisis, right? Okay. What are the features of these crises that led to, how can I say, the accumulation of a critical mass that then probably led to what you said here, an excess of capital? You had crises, didn't they, how they operated, how this crisis erupted, what was the causality mechanism first, and second, didn't they diffuse whatever problem was created, how this excess of capital was produced in the end of this crisis of the 1990s, at the beginning of at the end of the first decade of the 2000s. And then you said, okay, there was excess capital and this went all in the housing market. That's not a universal case. It's only in the US and several other economies, but it's not a universal phenomenon. And then there was a bubble. Okay, money going into a sector and inflating prices or whatever does not necessarily might lead to a bubble, but why this bubble has to be punctured and how? What was the last straw that break the camel's back? And then your explanation was that the crash happened. Okay, but why?
Okay.
Mike?
Okay. I'll give you, when I write about how crisis tendencies in capital never get resolved, they simply get moved around. I'm talking about a continuous process in which the contradictions of capital are playing an important role. And I again appeal to Marx. Sorry, John, I do, but when he kind of says that a crisis is a moment where all the contradictions of capital come together. And that's why I've just written a book on the contradictions of capital. And how they're constantly in play and they're never erased, like the contradiction between use and exchange value is something that's foundational and never goes away. And of course the contradiction between use and exchange value can be looked at very specifically in the case of housing markets and property markets and all the rest of it. As can the whole kind of question of how do you value the asset, what's the monetary value, and why do we have to have money as a measure of exchange value, and what's involved in the private property relations and all the rest of it. So there's a whole set of interlocking contradictions that actually pin together what's going on in the housing market right the way down to what the state does and did in Fannie Mae and Freddie Mac, and actually setting up a situation in which subprime mortgages became actually a state policy in order to integrate marginalized populations into, quote, the American dream, but at the same time, of course, create a market where there was no market before. And we find the same thing going on, of course, in microfinance and all of that, which starts as a kind of a charitable thing, microcredit, and has become a means by which finance capital is sucking value out of low-income populations, and it's doing the same very much, of course, in the housing market in the United States. But let me give you a brief sort of overview of the continuity of this. Between 1945 and, say, mid-1970s, there were very few financial crises around. Since 1975, there have been 10 a penny. Some countries have been through 3 or 4 of them in the last 30 or 40 years. The first big outbreak, of course, was the surplus capital that was recycled back to the New York investment banks in the mid-1970s from the Gulf states, with the oil revenues that came back. And this is surplus capital and had to find a place to go. The US economy was in the doldrums, so nobody was going to invest very much in the United States. So what the hell were they going to do with the surplus capital? Well, Walter Wriston's idea is we lend to states. And the reason we lend to states is because we can always go find them. So they lent money like crazy to, Mexico, to Ecuador, to Poland, to, wherever. And of course, what came out of that was what was called the Third World Debt Crisis, in which the poster child was Mexico. And in 1982, Mexico couldn't pay its debt back, and so what happened? Structural adjustment by the IMF and all the rest of it, which did what? It sucked it to the people in order to get the money out of Mexico to pay off the banks. And there was some haircutting going on through the Brady kind of thing. So there was a big crisis in Mexico. And it wasn't only there. If you look at the number of countries that were caught in that Third World Debt Crisis, it included, Poland, Ecuador, just it was a huge kind of thing. Surplus capital had been lent to countries at what seemed like attractive rates. Then the interest rate went up, and then bang, they couldn't pay. This is a form of accumulation by dispossession, which has continued ever since through IMF structural readjustment, and You can see very well how it's working right now in the case of Argentina. I mean, what's going on? Vulture capital, as they like to call it, is in there trying to actually screw the Argentinians over debt that was accumulated during a kind of a pretty corrupt regime, and you know, I mean, so you get into these sorts of things. So you're trying to get blood out of a stone, and so you know, I think that actually every IMF structural adjustment program is the equivalent to me of a bout of accumulation by dispossession. The standard of living of the Mexicans was reduced by about 25% in 3 or 4 years after 1982 as they tried to pay off the debt. This is actually taking, you know, assets from one part of the world and feeding it to the other. The investment banks are doing fine out of this, of course, and they're getting richer and richer and richer. So accumulation by dispossession has been a very important feature, and one of those areas where it's been, of course, in the property market. Many of the crashes that have occurred since the 1970s have been in the property markets. And again, I get sort of annoyed at some of the things because nobody looks at this and kind of says, well, this is a crisis of urbanization. Why is there this crisis of urbanization? What's the role of urbanization in relationship to this? And who's dispossessing whom when you start to actually use eminent domain or you start doing the favela reorganization structures in Rio, or you kind of try to clean out the slums of Mumbai to make way for condominium development and office development. You know, I mean, all these kinds of things are going on. So there's a lot of dispossession and displacement going on. And I think that there's a story to be told there about a neoliberal era that is not captured by some of this data that we're looking at, but on the ground. That included, of course, deindustrialization and the like, and the devaluation of a lot of the fixed capital investment that was around. So yeah, there's a continuous thing, and I'm sort of just jumping on various components, but there's a continuous kind of process where that was going on, and then it was increasingly difficult, I think, my hypothesis would be increasingly difficult after 2001 and the end of the kind of dot-com boom, and Greenspan kind of saying, okay, keep the interest rate real low. It was very difficult to stop the housing market being a very attractive target for speculative activity. And of course, in like all speculations, as somebody said, you know, I think it was David Cox kind of said, it keeps going until somebody gets nervous and starts pulling out, and then when you pull out, then, you know, the emperor has no clothes, and boom, you're soon in a crash. But yeah, that was not going on everywhere in the world, but it was going on in a significant number of parts of the world, including Ireland, Spain, Hungary, and Latvia, and places like that. So it was a very significant thing globally. But it was made global by the fact that it got into the financial system. As soon as it got into the pores of the financial system, Paribas went under, or didn't go under, but declared it couldn't pay. Right? Why? Because it had invested in all these collateralized debt obligations and that. So suddenly it appears in France, suddenly it appears in Germany, suddenly it appears all over the world, wherever anybody's invested in these things. And then, of course, the crash of the export, you know, the deleveraging in the US housing market, which has been absolutely spectacular. That deleveraging has actually created considerable stress in terms of consumer markets, and that, which means that China had to substitute its own internal market, not in terms of personal consumption, but in productive consumption and investment in infrastructures. So anybody who was oriented to the China trade, and we've seen a reorientation of Latin America to the China trade, and those countries which are actually supplying raw materials for China, like Australia, quickly recovering, because China was creating such a boom. China's consumed half of the world's steel supplies, half of the world's cement supplies over the last 5 years. So anybody producing raw materials for cement, and then of course copper, Chile recovered very well. And of course the other big demand from China is for soybeans. Latin America has turned itself into one vast soybean plantation for the China trade, and it's done very well out of it. But now China's faltering, and it's getting difficult, and it's not getting into the same thing. So all of those countries are beginning to experience difficulties. Brazil is in difficulty. Australia is not doing too well right now. I mean, you can see the way in which the thing gets transferred and translated, or how the geography of it is moving around. And so we're in a dangerous situation right now, simply because of the rockiness of the China thing. So that's the sort of story that I would tell.
Okay, we're going to run out of time. Can we go on a bit, Turan, if we need to? All right, Anu, please keep it short.
I don't know if I can do that, but let me try.
Then I will stop you.
Okay, fine.
Microphone.
I admire your work, David, and greatly, and have followed it, and no, but the but is the same but that you have about me, so it's not a different but. I read Capital very differently, and it's not because Marx said it, but because it is a fantastic resource. I see it as a multi-thousand-page project, an attempt to lay out a systematic foundation for analysis of the capitalist mode of production. And I was always impressed from the start about Marx's obstinate refusal to introduce something until he felt that it was the right place. And the trouble is that we then have to read it that way. You can't go in and dip, in my opinion, like a salad bar and take out what you want and throw the rest away. And that's one difference between us. I really don't think that's the right way to do it. So and it's possible that Marx changed his mind, but if that's the case, then why wouldn't he change his mind from the Grundrisse to Volume 3? How can he make those comparisons without addressing the issue of the logic of the argument? Then, if you accept that, one of the key things that we as economists have to do, which you perhaps don't have to do, is that we have to talk about issues that are relevant to economics, which are not particularly in Marx per se: relative prices, interest rates, exchange rate, trade patterns, stock prices, the effect of new purchasing power, budget deficits, and accumulation, and so on, and the recurrence, at least in my notion of crisis, of Great Depressions. Now, if you don't have that theory, then you end up doing what you do, which is you attribute these to power and plans of nations and groups of people. And you've said that repeatedly. This group, that group did it. And I don't think, I'm not saying there aren't such powers and plans, but I think that this is the only resort you have if you don't have any explanation of these other patterns. Let me give you an example. You talk a lot about deindustrialization. That's a deindustrialization of the US. As Ahmed pointed out, that's the reindustrialization and the rise of a new power elsewhere, so it is not, in fact, a systemic theater. It's the location of winners and losers, which is, I think, old history in the analysis of capital, that it moves around and it hurts some and benefits others. So I take the charge that you make very seriously, that we need to have systematic answers to these, and I don't think they can be presented in, half an hour, a year, or whatever. So, but I do think that we have to read Capital as a project which we may reject on its own terms. And if we reject it, that's fine, then we substitute something else. I find it a tremendous source of a connected set of ideas, and that can be presented, in my opinion, in another location. I've been working on this book for a long time for precisely the reason. I read your book before I started mine, so I have certainly had it in mind. But I come out with a very different thing. As for the falling red trumpet, I want to stay away from now because precisely it takes a little elaboration to explain and answer those, but I believe it's absolutely possible to make that argument systematically and address your concerns without necessarily persuading you in any way.
Do you want to come back briefly?
We're obviously going to have a very interesting discussion.
Yeah. He's got the Rocky.
I think David Cox wanted to speak incredibly briefly.
Incredibly brief. After initially expressing doubt about causation, you did give a kind of a analysis of the cause of the crisis as lodged in a process that goes back several decades of excess capital flowing into some area where it caused a financial crisis, and then it flowed into another area. But you also noted that this process did not happen before 1975. So what is it that you think changed about capitalism in the last several decades that produced this process that was not characteristic of the earlier part of the post-World War II period? And the second and related question is, big crises such as the kind we have now in the past have been followed by major restructuring of capitalism. Do you foresee a likelihood that the kind of processes we've seen for the last 2 decades, which some call neoliberal capitalism, that this is a system crisis of neoliberal capitalism that will perhaps lead to restructuring and a different form emerging?
I just want to make one comment to NY too. Actually, there has been a net loss of manufacturing jobs globally. So deindustrialization, yes, it's moved around, but you've got to have a theory of how it moves around too. And you economists are very good at looking at aggregate data, but you're not very good at looking at how it moves around.
We'll see.
Yeah.
That's a bit of a sweeping statement.
Yeah, well, I like sweeping statements.
Yeah, but you shouldn't incriminate everyone.
No. Come on. So yeah, I think the answer to your question is going to be given by Ricardo tomorrow, right? Is that correct? You're going to give the answer to that question of what happened with the rise of neoliberalism.
That's my point.
That's it. That's we do division of labour, you see. I'm not going to answer your question. You have to listen to him tomorrow.
So you're endorsing it in advance?
You have to read me.
Well, no, I may differ with him tomorrow, but pro tem, this is a good way out of the difficulty.
What about the restructuring?
Well, the restructuring
Does
is.
it lie ahead?
Yeah. No, well, I think there are a lot of issues that we haven't covered here, which are very, very important. I think this whole kind of question of should we reformulate the value theory? What do we do about? I mean, there's all this stuff about knowledge as capital these days, and cognitive capitalism, and so on. I actually don't accept a lot of that, mainly because it comes from certain kind of understandings I don't share, but nevertheless I think there's something terribly important there. What is productive labour and what is unproductive labour? I think we have to really think about that. As I mentioned in the paper, the factory labour, which we tended to think of as central, is gone. Except in Bangladesh and China and all the rest of it, but actually a vast amount of value is produced in New York City. And I use this figure of you stand on the corner of 86th Street and 2nd Avenue, and what do you see? Well, people are producing hamburgers, and why would we say that they're not producing value? And when Marx talks about the collective labourer, in Volume 1 of Capital, he opens a can of worms because the waiters who are actually serving them are part of the collective labour, and so are they part of the value production system? What's going on with the cognitive activities? I kind of mentioned, how is it that Nike, share value and shoe prices are far higher than they should be in relationship to any kind of measure of labour input? And it's all about reputation, and how do you create reputation? Has that something to do with value creation? And how do we account for the way in which Marx talked about the general intellect and talked about science and knowledge as being part of the value production system? There are all these kinds of questions because I think they're terribly important, because we're finding new ways of value production. For example, when we go on Facebook, we do the labour, actually. we do the labour at the same time as we consume it, and we've actually moved from a situation where there's a clear distinction between producers and consumers, that we've all become what Alvin Toffler calls prosumers. We create the value in Google, we create the value in Facebook by what we do. Who appropriates it? Well, it's a rentier relation in a way, and somebody's, you know, Zuckerberg is making billions, you know, out of our labour, and we've now got this system where you know, you check into an airport and you do the work. The consumer increasingly does the work, and actually use these new configurations. So there's a lot of things of this sort going on which need to be looked at, and we haven't looked at in this conference, which we need to pay attention to.
I've got a point to make. Ben's got a point to make. Is there anybody else at the moment? And Ricardo's got a point to make.
I would say, Simon, that's fine. I think we can go over it, but I'm going to give about 10 or 15 minutes at the end, so everybody should be prepared. With housekeeping.
Okay, I'm going to say something. I would like to mount a limited defence of an economist's focus on the rate of profit, because on some aggregate measure of the rate of profit. And the reason is that the rate of profit is a summary statistic which embodies a lot of different information, in particular information about the difference between labour productivity and the real wage, information about the difference between, or the ratio between labour productivity on the one hand and capital intensity on the other, meaning by capital intensity the amount of real fixed capital per hour there is in the economy. And finally, the ratio of output prices to fixed capital prices. Now those are just that's just definitional. It doesn't say anything more than is in the rate of profit itself, but it's an organising tool for thinking about the ways in which the overall economy works. And it is true that the rate of profit in some sense is a summary statistic of the aggregate capitalist economy. It's not inevitable that a focus on the rate of profit means a focus on the tendency of the rate of profit to fall. These tendencies can go in any direction. But what the rate of profit does do is enable one to organise one's thoughts. That's the first point. The second point is that if we think of the US economy for the moment, one can think of three big crisis moments in the last 80, 90 years. The first was 1929 onwards. The second was the period of the 1970s. And the third is the run-up to 2007, 2008. And what is striking is that 1929 was not a falling rate of profit crisis. 2007, 2008 was not a falling rate of profit crisis. But as Al showed this morning, the 1970s was a falling rate of profit crisis, and it was resolved politically and ideologically. There was no market resolution. It was resolved politically and ideologically. And it seems to me that that's quite important too. But the rate of profit enables a focus of one's thoughts in that sense. And I would like to defend it as a summary statistic in that sense. Now, I know that other people have a different view in terms of the inevitability of what tends to the rate of profit fall and crisis and so on. But one doesn't have to say the rate of profit will fall to focus on it. The last point I would say is that can one connect these various things to value theory in the manner that you problematise? Yes, I think one can, but clearly that's a big conversation. That's not something to do now. And the last thing I would say in terms of your Facebook examples and so on is that if you have a vision that productive labour in the world contributes to a vast pool of surplus value via its exploitation. And individual capitals, whether they be Facebook or whatever, extract from that pool through their competitive strategies, then that is an organising way of thinking about it. And you don't need to worry about what the particular workers of that making Facebook are doing, or what this particular waiter is doing, or anything like that. It's irrelevant in that sense. But that's sort of my perspective, and I don't think it's, other people clearly have different ideas, and Ben, presumably, will also have something different to say.
I'm okay on that. I think all of us are very conscious of a lot of students here, and there's one thing I wanted to say about that, which is hopefully they can observe that Marx 101 is nothing like microeconomics 101, where you receive conventional wisdom. Here, just the basic principles of Marxism are being heavily debated, and this is not received knowledge, and it's about the way in which Marxism is open to many, many different interpretations and not just communication of received wisdom. Otherwise, I wanted to say I very much agree with most of what David has said. There's a but coming. And the but is the framing of the issues with which he began in terms of a dichotomy or even an opposition between the law of the tendency, the rate of profit to fall, and the counteracting tendencies. And then the more favoured chapter 15, concerned with the issue of whether and how the massive surplus value can be continued to be accumulated. And I see these two things as the same thing. I don't see them as different from one another. The law and the counteracting tendencies are about not empirical movements in the rate of profit, although on occasion that will be important and a way to organise your thoughts, as Simon has suggested, but really we're concerned with, can the massive surplus value continue to be accumulated, and what forms does this take, whether in a crisis or not. So I think the law and the counteracting tendencies are relevant not just for understanding crises, but periods of accumulation which are successful as well. Just to encourage you to accept this, I would argue that the law and counteracting tendencies are concerned not just immediately with so-called economic issues, but with economic and social reproduction in general, for which your own work on fixes across various dimensions of that economic and social reproduction seems to me to be an appropriate way to proceed, but not in some sense separate from or inconsistent with the law and counteracting tendencies.
I agree with that, and actually, if you had the impression that I thought measuring, as you've been doing, or what's happening to the profit rate is irrelevant, that's not what I hope you would draw from what I said. In fact, I think it's very relevant. It's just that when you attach it to the tendency law, there's a problem. But also beyond that, I think there is a little space. I got worried a little bit by the tendency to make it seem as if it's so factual that there's no interpretive frame that needs to be put around it. And I think that it would be helpful to have, well, what does this mean, you know? And I think the way you explained it is fine, and I'm very happy with that, and I'm very glad that to see, and I was very glad to see what you were doing with it, what Anwar was doing with it. I think this is extremely helpful. So I'm not questioning that at all. So I hope you didn't assume that.
Ricardo, you've been dying to say something short.
I'm dying, but not to say something short. No, I try to be as short as possible. My kind of intervention is the opposite. I start saying what I disagree on, which is the way you began, which by the way is very similar to the way I began tomorrow, about money as a necessary representation of value. But on this I say nothing. On what you said about the falling rate of profit, I agree completely, and then I will stop now. But unfortunately, it is there that I want to say something. That is, I will try to defend Marx's idea that somehow, somewhere, in some way, I don't want to go into the detail, is that there is a priority of the tendency of the rate of profit to fall. Let me open a short parenthesis. I think that all the work about the measure of the rate of profit are important. The point is that from there one can say nothing about the falling rate of profit. On the contrary, one cannot say that the crisis of the 70s was a falling rate of profit, because everybody worked on ex-post magnitudes, and this does not allow for me to distinguish. What is my defense of Marx's idea? Very quickly. The distinction of use value and value, or distinction of position, exteriorization, becomes capital in the place of value, living labor in the place of use value. Living labor extracted from living labor power, that is, from the bidders of that living labor power, the workers. Now, Marx arrived at the conclusion that there is an internal drive to the expansion of surplus value, surplus labor, and this gives way to an expulsion of workers from factories, let us say factories. This, by the way, for me is the definition of capital. Not money, not commodity, a social relation. From there, you are one step to a falling rate of profit theory. Because if you imagine, it is just an abstraction. All the world, because all the reasoning must be global, all the world, you imagine that the wage is zero, it is ridiculous, but Marx does that one time. If you imagine that everybody works 24 hours a day, you have that the surplus value is the total new value. It is the total living labor expressed in money, in the numerator. It has an absolute limit. There is no absolute limit to the increase of constant capital at the denominator. There is a maximum rate of profit. I don't buy this story, because I think that there can be a change in the price of output relative to the price of the element of constant capital, so that the denominator does rise not so much, does not rise. But this is the idea. So, two phrases to end. There is a reason why this is the tendency. Then there are those that Engels calls the counteracting factors. For me, this gives an organization to the thinking of the crisis theory, which goes actually, I think, in your direction, because the point is to understand how the fact that the counteracting factors wins is the cause of a succession of crises in different forms of capital. So to relate chapter 13 to chapter 15, so to speak.
Right.
That's my way of thinking. Okay.
David, do you wish to give a grand summary in any sense?
Oh, you said that in such a grim way that I couldn't possibly try to do it. So